This is the Kestrel Country podcast, where we discuss the people, places, and events all around Kestrel Country. So, given that it's been a while since we've recorded a podcast, I want to talk a little bit about what's been happening in real estate and a little bit of some predictions for the future for coming into next year. As it is, as of today, we're getting to be late October. So beautiful fall here on the Palouse, and it really has been a beautiful fall. We've had amazing weather, and it's been great. But let's talk a little bit about what's been going on in the real estate market. So the last 2 years, I would say the way to classify it here, and I'm talking about locally, but it's really been true nationally too, is a bit of stagnation. It's been slow and weird. What do I mean by weird? Well, it's been, the market's not been totally dead, but there's just been a low number of transactions overall and a little bit of a stalemate with both buyers and sellers being a little bit more on the fence. With sellers, a lot of that is coming from the super low, kind of artificially low interest rates that we saw post-COVID. So there are a lot of people who either bought or refinanced in that time where interest rates got super, really artificially low in the 2s and 3s. And then obviously shot back up, got almost to 8%, and have been kind of hovering relatively high in the 6s and 7s the last year or two. What that's done is had this lock-in effect where basically it's hard for people to want to trade up or trade out of that really low mortgage rate that they've got fixed for 30 years and buy at this higher rate, especially when prices haven't come down. And part of why prices haven't come down is because of that low inventory. So it's a little bit of a trapped cycle there. And then that's on the seller side, why inventory is low, which then, again, keeps prices relatively high. And then we've also seen on the buyer side, obviously, that difficulty of high interest rates and stubborn prices creating a little bit of, again, this stalemate. So, homes that are priced right are still selling quickly. We've even seen some recently with multiple offers when they're priced right, but anything overpriced at all is just sitting on the market. So that's generally what we've been seeing, but some promising signs going into this later fall as interest rates have started to drop. Although what often happens this time of year is that when people see those interest rates start to tick down, they think, all right, they're dropping. Let's not jump in too soon. Let's wait till they drop further, wait till spring. And maybe there's more inventory and lower rates, right? So that's kind of what we've been seeing in the market. It's been a weird couple years, but very grateful for continued, strong business for us, for our team here. And I want to get into a little bit next about why I'm optimistic for where the market is headed. I'm going to base some of this on an article, it was an opinion piece from a guy named Gene Marks at The Hill publication. And I talked through this with my sales team a couple days ago at our meeting, but just wanted to bring up some of his points and then talk about why I really think that he's on to something and that we will see a boom or at least a real uptick in the market coming into next year. So the headline he had here was, "A real estate boom is coming. Are you ready?" And what the author outlines, first of all, he acknowledges a lot of what I was just saying, that we've had kind of a tough spot in markets the last couple of years, both commercial and residential markets. Higher prices, low activity, high borrowing costs, this kind of just slow, weird market. But he predicts it will change, and his prediction is for a really significant boom. So a lot of then what follows is him kind of going through what are the ingredients, and then he believes those ingredients will happen, but kind of what are the triggers in the market that would create that boom. The first one is mortgage rates having to fall, and his trigger that he gives is probably below 5.5%. Obviously, that one's pretty obvious, right? So as I was mentioning before, higher interest rates is part of what's really creating this issue. And I say high, but really it's higher than they were at those artificial lows. Historically, the rates we're at now, around 6% are pretty good rates, really. But he does predict they would need to drop and probably in that 5.5 range. Indications seem to be that is what's happening. The Fed, which again, the Fed rate and mortgage rates are two completely different things, although they do have some relationship in the market forces. But the Fed has indicated that they predict that they'll continue to lower rates. We do expect that the mortgage rates will drop. And one of the things that's going to do is not only help those buyers out and get off the fence, but also help free up some of that inventory. So a couple of interesting statistics from that article. It says 14.3% of outstanding mortgages have rates at or above 6%. So those are people who are definitely going to benefit, right? I mean, if all of a sudden your rate goes down to 5.5, then there's a real motivation to make that move or refi, right? It could be refi, but it's going to at least free you up to be more attractive to moving. And then almost 2/3 of mortgage holders are between 3 and 6%. So those are the ones where, let's say they're at 4.5, let's say they're at 5%, let's say they're in that range. It's still lower than what the rates will be. That gap closing is going to help free them up and maybe allow some of the other motivations that they would have to move to win out over just rate. So I think that he's right on there, and the trend is heading in the right direction. If inflation expectations are curtailed, bond market yields, which that's really what drives mortgage rates, is the bond market. If they decline a bit more, we could see getting into those rates here in the next year, 5.5 or less. And I think that really will free up some things in the market a lot. And then the other side of that is commercial. We don't maybe talk quite as much about that, but there has been quite a bit of talk about potential crisis in the commercial real estate world, and particularly these adjustable rate mortgages that are on generally 5-year terms, coming due, not necessarily due, but adjusting the rate. Well, that adjustment seemed super dramatic when rates were really high. But the Fed's rate cut, where kind of affecting prime, and that continuing to come down, really could save that from happening, and even increase some buying on the side of commercial. So I think that really could help kind of preserve the commercial market and even help grow it, particularly if the economy continues to grow. Right, one of President Trump's initiatives with tariffs and other things he's doing is really to grow U.S. industry, U.S. manufacturing, U.S. commercial sector. If those things start to happen and the rates are a little bit more attractive, really could see some growth there in the commercial sector. So rates are kind of that first trigger, right, that he talks about. Second is the stock market. This is something that's been obviously in the news a lot, and it is high. I mean, as of today, I just saw a headline this morning saying that the stock market hit another all-time high. So despite a lot of the fear around what are Trump's tariffs going to do, he's going to tank the economy, all of these things, we're actually seeing that the stock market's been performing very well. Now, the author's point in the article that we're talking about is that the market will need to hold or grow, right? So if we saw a crash in the stock market, that would obviously affect the housing market. So that is an ingredient to watch. A lot of people might think that, we're at this all-time high of the stock market. It's ready to crash. Maybe that's going to happen. That's something that's totally outside of my area of expertise. I don't know, but just something to watch, because of course, all these other forces could be very strong. But if we saw a huge downturn in the stock market, that's going to affect everybody, including the housing market. People's confidence goes down, all of that kind of thing. So something to watch. But again, I think that, in my opinion, some of what Trump's doing, some of what's happening in the market, should keep that relatively strong for a while. That's my opinion. So we've talked about rates, talked about the market. Third thing is income. And this is where the job market has been a little weaker. That's obviously why interest rates have come down. But while unemployment has been a little bit higher, again, prompting the Fed to drop rates, the growth in wages has actually been pretty strong. So ADP, they're a payroll processing company. They reported that over the last month, wage gains among job stayers was 4.5%, and among job leavers, 6.6%. So people moving on to a new job or staying in their job, again, 4.5, 6.6. So in the middle there, somewhere around 5%, right? Job wage gains. And that's real-time accurate data from a payment processor. Inflation, however, is currently running around 2.9%. I think there was a headline today, 3%. So again, ticking up a little bit, which could be concerning. But that wage growth is definitely outpacing by a fair bit that inflation, which again is good news. And this is going to allow, particularly maybe first-time home buyers, the ability to save more, the ability to not just save more, but maybe then afford more of a monthly payment as their wage growth outpaces inflation, and get off the fence and move in to the market. Another headline that got a lot of attention is how the first-time home buyer average age has gone all the way up to 39. That's a topic that I'd love to talk about more, probably another podcast we need to do. But this may be something that can help some of those younger home buyers as wage growth does occur and inflation taps down a little bit. Might get some of that, and more buyers is obviously going to help the market. So maybe moving from renters to ownership in the next few years, really another good headwind for the market. Now, number 4, so he had 4 points again. We have interest rates, stock market, income growth, and then the last one is interesting. This is more of a demographic change of the wealth transfer from baby boomers to the next generation. So this was kind of an astounding number. He talks about a generational transfer of nearly $124 trillion in assets over 25-year period. Now, again, I know 25-year period is a long period, but we're entering into that, and that's a huge number. So wealth transfer from that generation to the next generation, basically older Americans to their heirs, to their spouses, to charities. They're predicting a huge amount of wealth transfer coming in the next few years, which will generate activity again. I mean, some people will maybe just pass down their real estate and have it still held, but some of that will come available, and more importantly, a lot of that wealth moving to the next generation is going to allow them to invest in real estate, to move up into bigger houses, all those kind of things. And so that shift that we're going to see here with that wealth transfer is pretty significant, and should again provide some big headwinds to that. So in conclusion, this gentleman says everything is a cycle. For the last few years, real estate industry has been moving downward. We just talked about that. Kind of in Moscow, it's been more like stagnation rather than moving downward. But as all these things are cycles, it will change. It will be a boom. We don't know exactly when that'll happen, but again, it is coming. Those things will change. And I think that we need to be ready. And obviously for us in real estate, that's an important thing, but for home buyers as well, whether you're an investor, first-time home buyer, getting all of your ducks in a row and being ready for that shift is going to be really important. Because one of the things that some people often say is like, well, I'm just going to wait till interest rates come down and there's more inventory, maybe prices will drop. that may be true, but generally speaking, as those rates drop, as more buyers enter the market, again, markets are supply and demand, you're going to increase the demand side as well. And it's going to be tough. There's going to be competition. And so getting your house in order now, getting your ducks in a row, getting ready for those things is, I think, really what behooves you. To speak to maybe especially those younger first-time home buyers or people who are renting, getting ready to buy, I thought I'd share this kind of interesting strategy that one of my buyers had that I thought was super smart. I don't know if it was their idea or if it was given to them by somebody else, but what they're doing is, I guess, one of the reasons why we're seeing those home buyers, especially first-time home buyers, delaying so much and maybe holding out is because right now it is on a monthly basis definitely a lot cheaper to rent than it is to buy. That's just the reality. And so, I'll use some real round numbers. Let's say it costs you $1,500 a month in rent right now, and you're looking at a mortgage to buy a house. You want to get a decent house, whatever, you're looking at $3,000 a month. Again, just throwing out round numbers. So twice as much in mortgage payment than you're paying in rent. Well, a lot of people just can't stomach that. And sure, there are times where you just can't afford it, right? And of course, go talk to a lender, get pre-qualified, figure out what you actually can afford. But if it's just that strength, that preparation for like, man, how are we going to go to paying twice as much a month for our housing costs than we are now? What this young couple is doing is actually basically already budgeting for and quote unquote, I guess, paying out that higher amount, again, using fictitious numbers, but say it's $3,000 a month. So they've got $1,500 a month in rent, and then that other $1,500 they're putting away into a savings account that's kind of hidden, right? It's like almost out of touch, that they're putting away every month. So what that does is not only prepares them for it, but really also builds up that nest egg, builds up that cash for either reserves for repairs and things in the future once they're homeowners, or for that down payment. But I think more importantly, again, it's just creating your monthly budget around it so that it's not this big scary leap. You're already used to it, and man, we know we can afford $3,000 a month because that's what we're putting away now. So I think it's a cool idea, something that could really be a big benefit, and would encourage other young home buyers to be doing something similar. So, that's about all I have today. Shorter podcast. You just get me, but wanted to jump back into it. And we've got some fun episodes planned now with some guests and working to have more. So if you have any ideas for guests, ideas for podcast episodes, definitely send them in as we're jumping back into this Kestrel Country podcast. So hope you have a great day and enjoy this beautiful fall.
Thanks for joining us. Like, share, subscribe. We'll see you next week.